Hi everyone, welcome. Thank you for joining us for today's panel session. We have a great lineup of panellists for you who are going to share their thoughts on the market over the past year and also what to look out for next year in 2022. Now, by way of background, the last couple of years have been a very crazy, dramatic time. The pandemic has impacted our lives, our communities, our kids and businesses, both big and small. But despite this backdrop of economic turmoil, share markets have recorded some of their biggest gains in history. Since the plunge we saw in March 2020, most markets are now well above their pre-pandemic levels. Our panellists today are going to share their experiences on what was really an exceptional year on the ASX and also look to the forces that are likely to shape 2022. And hopefully along the way, we'll also get a couple of stocks to keep an eye on for next year. So stay tuned. My name is Paul Rayson. I'm the CEO of Hearts and Minds Investments Limited, and I'll be your moderator for today's conversation. But first, let's meet our panellists. I'll ask each of you to give a brief introduction and tell us a bit about your fund or your business, and then we'll move to the questions. First, needing very little introduction, we have Jun Bei Liu, who is the lead portfolio manager for the Tribeca Alpha Plus Fund. And before I pass to Jun Bei, I must say that Jun Bei has been a star speaker at the Hearts and Minds conferences. I think you've spoken 3 times at the conference, and each time it's been a standout stock recommendation. And we're very much looking forward to having you back next year when we go live in Hobart. So welcome, Jun Bei.
Thank you. Thank you very much, Paul, for such a lovely introduction. And it is such a pleasure to be amongst this panel this morning. And absolutely, I'll be back next year at Hobart at the Hearts and Minds. I'm very much looking forward to have a face-to-face conference. Look, today's panel, thank you so much. Let me talk about a bit about my fund. So I am the lead portfolio manager for Tribeca Alpha Plus, which is a long-short fund that invests across the top Australian companies. So my benchmark towards ASX 200, but I can invest up to, down to very tiny microcap companies, essentially going after where the investment opportunity is. The fund has been around for more than 15, 16 years. And, we have been rated the #1 long short on 3-year level with Mercer. So it's a pleasure to be here this morning.
Thanks, Jun Bei. Next, we have Rob Gregory, who is the founder and CIO of Glenmore Asset Management. And before I pass to Rob, I'll just say one thing, because I know he'd be too modest to say it, but in the latest Mercer survey to the year to 30 September 2021, if you put aside a geared fund, which came first, Rob's fund came the second highest returning fund in the year to 30 September 2021. So I think a 63% return, Rob, so outstanding. Pass over to you, Rob. Welcome.
Yeah. Thanks, Paul, and thanks for being part of today's conference. So Glenmore Australian Equities Fund, it's about 4.5 years old, starting in June 17. The performance has been very strong since inception, up 25% per annum. And really, it's a long-only fund, investing in ASX stocks. It can invest in any market cap, but there's probably a predominant focus on small and mid-cap stocks, and really looking for businesses that have a quality business or a quality service and have the ability to grow earnings significantly over a 3 to 5 year period. And hopefully that growth is not properly factored into the market cap at that point of investment. So that's basically the focus. Really looking for quality business that we can buy and hold over a long period of time.
Thanks, Rob. And also needing very little introduction is Niv Dagan, who's the Executive Director of Peak Asset Management, a boutique investment management and corporate advisory firm, and also a bit of a media presenter too, I think, Niv. Over to you.
I don't know media presenter, Paul, but thanks for the introduction. So I run Peak Asset Management. We're a boutique investment management corporate advisory business, Melbourne-based. Our whole philosophy is based on co-investment, which means we don't put opportunities in front of investors, and they might be your high net worths all the way to your small cap fund, institutions, family offices, unless we're co-investing and backing it with our own capital. We're sector agnostic, which means we look at any space in any sector, and it's great to be here. So thanks very much.
Thanks, Niv. And we're also very lucky to have Cath Whitaker from SelfWealth, who's representing retail investors today, Cath. So welcome to you.
Thanks very much. So Cath Whitaker, CEO of SelfWealth. We're all about empowering people to achieve financial freedom. As you mentioned, Paul, we've been the advocate for retail investors for almost a decade now. Recently voted the most popular Australian trading platform in Australia by Finder, which is a fantastic award to receive. We're all about looking at what our members trade, building out community, sharing out advice, and of course, providing independent thought leadership and content on trading activities.
Great, welcome. Well, thanks for all joining us again. So let's get into it. Let's talk about 2021 first, and some context, primarily for our fund managers first. And as I said at the top, the pandemic has caused massive personal and economic disruption, and that's disruption in the old sense of the word, which has led to massive fiscal and monetary stimulus, which of course sent markets skyrocketing. The ASX 200's up, I think, over 50% since March 2020. And it also recorded its best one-year return for FY21 of 32%. And, depending on how you measure it, it's been the best one-year return for 28 years since 1993. And also during the year, there's only one negative month during the whole of FY21, which is quite remarkable. And US markets have done even better. The Nasdaq has doubled since March last year, and it's nearly 60% higher than pre-pandemic levels. So it was a very good year, both for fund managers and for investors. But if you cast your mind back to last year, it wasn't obvious that the market would keep going up. So, as a fund manager and as an investor, it must have been hard to stay invested. So the question really for our fund managers is, how did you navigate the markets over the last year? And what calls did you make to outperform the market? And maybe illustrate with a stock example or two. I'll start with you, Jun Bei, if that's okay.
Of course. Look, I was just thinking back, oh my goodness, what have we been through? It was absolutely a roller coaster ride. Look, market has gone through a lot, and the strong performance, the incredible performance, really just reflection of the incredible optimism that the equity market and resilience of the equity market was. So when the pandemic first hit, clearly, so when the market was sold off, it's though emotionally it felt like a terrifying time when the market was falling 5-10% a day, and it seems to be nothing to catch it. Now, for most of us, before the government stimulus steps in, it was really a period that none of us have ever experienced, because people pointed to the last pandemic. The proper pandemic was 100 years ago, and many of us didn't quite live through that. So and let alone to see how share market respond in that kind of environment. So that's why the initial free fall was really there's no one there to catch it. But what we saw when the free fall took place after a few weeks, what we saw was some of those assets, especially hard asset players such as Sydney Airport, such as Ramsay Healthcare, or the shopping centres. We just saw the value of the hard assets. Now, we don't know if the government, we didn't know the government was going to step in and rescue the world, or the interest rate and any of that. All we knew was the hard asset will stand. Regardless of what happens, it will stand. So, and that was the time where we wrote newsletters to our investors, and, we jumped in and invested. We just saw this once in a many decades investment opportunity for some of those most premium and priced assets. What was interesting was there was no one else ready to catch it. So, we pretty much just bought when it kept falling. And then you saw the government stepping up, government doing different things, and interest rate were lowered, there's stimulus and all of that. When that took place, that absolutely builds confidence. Then that's when we know, right, now, not just hard asset, which we bought, we need to start buying some of the businesses that's actually leveraged to, good, high quality businesses that have strong customer franchise, and that is leveraged to a lot of those stimulus. So, there was the retailers, there was, a lot of those businesses that we just saw at very early stage, things will benefit them. And the government, there is someone to support the consumer, and there is someone to support the jobs. it's not really just a abyss that we're looking down. There's nothing to catch it. So by then, I think the confidence was building. This is pretty much around late April, May. We just seeing a lot more confidence. This is 2020. We see more confidence coming into the market, and then started supporting those businesses. Now, along that way, that journey, I think constantly as a fund manager, people said to me once, funds management is like climbing a wall of worry. So you always worry about something. And, it's not just buy something, close your eyes, it'll be fine. No, it won't, because you need to know whether the world is moving the right direction, whether the stock price has gone too far. So, there's a lot of to and fro around that journey. Something's gone too high, you sell some, move into the ones that hasn't been perform as well. And they're essentially inching towards, what the ultimate outlook will be, which is a reopening of the economy. I must say this journey has been quite interesting, because that journey, we thought the economy will reopen by the end of last calendar year. All of us have thought, it'll be fine. There'll be no Delta. As long as we got vaccination, everyone's ready to go. But everything takes longer. So we've got all these gyration in the market, and yet moving towards the right way. But it has given us so many buying opportunities for companies. We know in 12-month time we'll be fine, but it just takes time. And, just a lot of buying opportunities along the way that has really provided active managers to really outperform the market, because we can take a longer term view. And then we got there on the basis of, all the government support, cheap money around, keep the consumer working, keep the corporates, keep the jobs. And now that we ended in a place much higher than we were before the pandemic, which is a good outcome.
Yeah, no, there was a lot of stop-start, a lot of uncertainty along the way. So it still required, I think, a lot of courage to stay invested. There's a couple of examples that come to mind, though, that of quality things that were really sold down, that you rode the ride all the way back up.
Yeah, that absolutely. So that's the thing. So many times when share price first move, you think, I made 10%, maybe I should take profit. But look, for a lot of quality businesses, you really need to sit there and wait for the ride, wait for your quality companies to generate the return it deserves. So, things like Sydney Airport, it actually took quite a long time before the return came around. Look, we actually thought, the price is actually north of $9, but, with the bid and things, obviously given the times and aviation, it's a fair price. But look, these things, you need to let things play out. You have a price asset. Don't worry about when it will be, because it will get there eventually. Like Treasury Wine, we looked at not so much pandemic. It's more about tariff, trade war, China, and at the time when share price hit $8.30, we just thought, look, it doesn't matter if China's buying it or not. We know it's a brand. We know all these Penfolds will sell, and it will. And if we clear those Penfolds, it will be more than the price it was trading at. So this is when you step in and say, let's buy this. Let's not worry about what will happen to the trade war, because we know it will pass, but in the short term, who knows? And then just buy the assets. And this is how you realize the value for an investor. And then, to work with the market opportunity.
Yeah. I think the Treasury price was underpinned by the bottles of grain sitting in the cellar, I think, wasn't it? Rob, I'll turn to you. How was the journey for you? You've had an outstanding year. So, how did you navigate and outperform by so much?
Yeah, look, I think firstly, for any investor, that initial period, a big decision was to hold on to the stocks you own. So I can only speak for myself. I went into COVID with a portfolio of stocks, that companies that I really believed in, and I believed in the earnings rolling out over the next 3 to 5 years. So, in a lot of instances, the hard decision was actually to hold on to businesses that you owned, even in the face of stock price falling very significantly in the space of a month. Then I guess you moved into the next period of sort of March, April, where stock price had fallen very significantly, and you had to sort of think about what the earnings impact was going to be. But to be honest, like in a lot of stocks in my portfolio, the stock price fell so significantly that it really got to a point where you only needed to believe in a reasonable earnings recovery over the medium term, and the stock was significantly undervalued. We saw some very significant price falls in a lot of small and mid-cap names, just as people ran for the exits, which was totally understandable because, I mean, I worked through the GFC, but COVID was a really different sort of a scenario altogether, really, where 2008, 2009, you had significant financial institutions having real financial pressure, whereas COVID was very different. So it was a different scenario, as Jun Bei said. So that, I guess, we just had reporting season in late Feb. The first thing you do is you speak to as many companies as you can about how they're seeing things. But I think in a lot of instances, investors probably underestimated the ability for companies to keep operating even under that sort of COVID, work from home and type environment where, certainly in some of the mining services, the miners, they could keep going. A lot of businesses like quarry or financial institutions, people just had to start work from home. But in a lot of instances, business could keep going. And the earnings impact didn't end up to be anywhere near as bad as what had been feared in March. In fact, in August, we actually had quite a recent reporting season. So I mean, in terms of, so firstly, I guess what I did, I held on to a lot of the businesses I was very confident on. I certainly made some selective opportunities investments. So, I mean, a few that spring to mind would be Collins Foods, which is a franchisor of KFC outlets, primarily in Australia and New Zealand. So that was a business where the stock price halved, I guess on the basis that people thought, well, we're not really sure what's going to happen to earnings. And probably after sort of a 3 to 6 week period into COVID, you could see that the earnings impact wasn't going to be too bad. In fact, the takeaway part of the business was actually going very strongly. So that's one. AOB Corporation, which sells 4x4 accessories. That's another one that fell very significantly. And I think after 4 to 6 weeks, you could see that that business was intact and the valuation was very attractive. I mean, another one that springs to mind, Premier Investments, which is the retail investment company run by Solomon Lew. And again, there's been a whole range of small and mid-cap stocks, same scenario where the stock price halved, earnings impact wasn't nearly as significant as what had been feared, and you probably had about a 4 to 6 week period to invest before the stock prices started to recover.
Yeah, well, just one that came to mind that I think was I think you had Alliance Aviation or something. Is that what it's called? Yeah.
Yes.
To buy an airline in the middle of the pandemic, I thought was pretty inspired, and it's done amazingly well.
Yeah. Well, I mean, in the case of Alliance, it's not actually. It provides services in the aviation sector, but more to sort of mining companies for the fly-out type of workers, so that they weren't quite in the same bucket as a Virgin or a Qantas. So initially, everyone was just like, I don't know what's going on with this company. COVID would cause some issues, but in fact, COVID was actually quite good for the beneficiary because clients wanted more safety for their workers and actually an uptick in their demand. And in fact, I mean, one of the things that played out quite positively for Alliance was that the mining sector was actually, after that initial sell-off, was actually quite immune in a lot of ways, particularly over in WA and Queensland to COVID. So, so that's one that, the stock price fell. I mean, I think for myself, the companies that I had more confidence to invest in during that sell-off were businesses that have been around for a long time. So you had they're established businesses that in a lot of instances I'd seen trade through GFC. So you had one data point, I guess, of seeing how they traded through a period of stress. But look, there was a lot of opportunities out there, that's for sure.
Yeah, no, well done. Outstanding returns. Niv, you advise and co-invest with a lot of small caps, and how did 2021 go for you?
Yeah, look, it was an interesting year. What Jun Bei said, and Rob, I do agree with. I mean, buying hard physical assets at undervalued relative to the market. So that's the key. And we saw that in the GFC, and especially these type of companies need to recapitalise their balance sheet. So it did provide investors an opportunity. There was a lot of IPOs and placements at deep discounts relative to their net tangible asset value. So from that perspective, there was a lot of opportunity. I mean, 2021 was an interesting year. I mean, it's all been about the circular economy for us and ethical investing. And I know Cath will probably explain about that further in terms of her alignment with SelfWealth. But look, all about green hydrogen, all about plastics, all about waste to energy, all about the lithium-ion battery. So those type of themes were really paramount for us. And I'll give you an example. We backed a company called Range International. Essentially, they take pallets. There's been, for those at home that are listening, obviously a big issue with the whole supply of pallets made out of timber. The company Range, simply what it does, it takes recycled plastics and converts it into pallets out of plastics and waste, essentially. And they're cheaper, they're stronger, they're more reusable. And look, we backed it at shell value at around that 2.8 mil EV. We did an underwritten rights issue, and now they're up over 150%. Excellent management team, good track record, moving into EBITDA positive. Another business that we backed is a company called Beam Communications. Obviously, with the whole travel economy starting to open up, we did look at that travel sector, and we did speak to the CEOs of J Rides and Apollo Travel, and we thought that travel is going to come back on. Those people that are locked up at home for 12 months or 18 months want to get out. And what Beam does is they're connected to a company called Iridium, which is a $5 billion network, satellite network. Anywhere in the world, you can essentially have remote telecommunications. It's a two-way GPS tracking, weather. It's a fantastic, and look, strong management, strong balance sheet, trading at one-time revenue. If you compare like a Life 360 is trading at $1.88 billion, Beam's trading at 30 million enterprise value. So look, we thought it was undervalued. We approached Michael, the CEO, and he said, look, Michael, what about if we helped you out and did a placement with some options? Did that at 25 cents. The stock's now trading around 55, 60 cents. So it's had a really nice uplift, but we see a lot of upside as the European market open up. They've got launching New Zealand, and they're getting some really strong traction in Australia through Australia Post and Anaconda. So look, I think the big theme is really the circular economy, hydrogen, uranium. We can go into that as well, waste to energy. And I think that's going to be continuing in 2022.
Thanks, Niv. Yeah, Beam have done particularly well. People finally discovered it, I think, and realised how profitable it's going to be. Cath, for you, SelfWealth has had a pretty amazing, well, you've been going for 10 years, I didn't realise that, but pretty amazing year the last year. And I noticed that the number of active traders has increased a lot, and your trade volume has increased a lot. But I also noticed that the value of equities under HIN has increased by a greater amount. So in aggregate, it looks like investors have done well. And I know you don't track individual investors, but do you have some sense of how the average SelfWealth investor fared over FY21?
Yeah, absolutely. So, looking at actually September year on year, as you've pointed out, so active traders number increased by 58,000 people up to now over 107,000 people. But whilst at the same time, although we know, all odds increased by, just over 21% in that September time period, value of assets, we can see increases more like 25%. So it's an absolute true statement to say that SelfWealth members are outperforming what we're seeing the growth in the All Ords. And when we think about, well, how did our SelfWealth members do that? So, we think in terms of trading behaviours, I think there has been a lot of love out there for indexed ETFs. I think it is an easier way to go about investment decisions, certainly for retail investors. But once you get beyond that, we saw significant trends in terms of, people falling in and out of love of buy now, pay later stocks as, the market became more crowded. Certainly a lot of support given to a few of the big banks that outperformed the rest. As Niv was mentioning, there is a lot of interest out there in terms of circular economy, EV-related stocks, so anything with lithium in it. And, SelfWealth is the first broker in Australia to provide free ESG data to all members. So, there is this real desire out there to do a bit of work from the retail investor point of view. And it's terrific to see the success that our SelfWealth members have had.
No, that's great. No, thanks, Cath. So let's turn to the year ahead, which I think is going to be much harder. So after the exceptional returns of 2021, what does happen next? since about August, the market sort of drifted sideways to sort of down slightly. And it's really lacking a bit of direction, and there's a fair uncertain outlook. There's a long list of risks and uncertainties ranging from supply side disruption, the spike in inflation we've seen, the timing of monetary tightening, China slowdown, geopolitical risks, and even the re-emergence of COVID. But to narrow the conversation down, let's just bundle up supply side disruption, the spike in inflation, and the risk of tighter monetary policy. Now, one school of thought goes that the recent spike in inflation is driven by temporary factors, government stimulus, pent-up post-pandemic demand, supply-side constraints, labour shortages, border controls, and so on. And the thought goes that this will even out. This will even out over 2022 as supply chains work through the backlog, people get back to work, and globalisation starts working again. And related to this view is that central banks won't raise interest rates too far because it'll stifle the recovery, or probably more importantly, we just can't afford it. The world has too much debt and we can't afford too high interest rates. The other view, though, is that the long decline we've seen in interest rates over 40 years is coming to an end, and that the deflationary forces of globalisation have peaked, and cost increases and localisation will start to feed through to costs and wage growth, and inflation quickly get out of control, and central banks make a mistake and increase rates too far, and that really whacks the markets. Now, the answer is probably somewhere in the middle, and I don't know the answer, but probably starting with you, Jun Bei, how are you thinking about inflation and interest rates, and how's it likely to change the way you manage your portfolio for the year ahead?
Look, absolutely. That's actually a fantastic sum up of what sort of factors and things that as fund managers are thinking about and worry about and reposition their portfolios about. You're absolutely right about the the short-term inflation. Absolutely, these numbers will look very high. Could be alarmingly high, However, most of the central bankers around the world are of the view that this is transitory, and we can point to many reasons of why it is transitory, because of supply chain disruptions, the borders are closed, labors that the labors that used to move around the world are not happening, so businesses can't find people to to service a lot of those roles. So all of that will add to short-term inflation. And it is going to last longer than what most of us previously expected. Many of us expected that to pretty much complete by now. And it looks like we'll be here for the next 6 to 12 months. Now, the good news is, a lot of factors that were driving deflation haven't really gone away. So, the technological advancement and things, so that's still there. Aging demographic hasn't really changed all that much. We did have a baby boom, but that's going to take some time before it comes through as labor. And also the supply chain, the latest US reporting season, the September quarter, we heard large multinationals have talked to some of their, operations and manufacturing in the emerging market are now reopening for business. So, this is just early indications that potentially the supply chain disruption will get better, just very, very slowly. Now, but we do believe some of the issues within pandemic has changed. Pandemic has changed the way we do business. So the supply chain is changing, and that will add to a fixed cost going forward for the long term. So what's really changing is that because of the massive disruption happened across the supply chain, all the business has realized that the old school thinking of just in time, which is about how to lower the cost of making a product and get to consumer and make it only when someone buys it. So that sort of concept won't work anymore going forward, because if one country shuts down, you've got no product, and that is a big problem. So companies are moving from just in time to just in case supply chain, which means You want to always constantly have access to the product should something happen. So most of the businesses, especially the large multi-corporations, are now stress testing their supply chain. They are investing more in their domestic geographies where they supply their customers. So which means they will have small manufacturing producing, say, chips and things, rather than outsource 100%. And they will make sure there's enough warehouse to store some of those inventories, keep more products around, keep more people around, employ more people domestically. So all of that will get to higher costs, but it is good for the local economy where the product is sold. So, with that combined, we do think the cost will go higher, but most of the inflation should go away. Interest rate, yes, it will go higher, but don't be alarmed. Interest rate around the world is at all-time low. And remember, the reason it's at all-time low is because the pandemic support. When pandemic hits, no one knows what's going to happen to consumer, to corporates, to ensure things will go as smoothly as possible with all the pandemic-related disruptions. The governments and central bankers had come out and making sure that there is an emergency. There's as much money as possible for anyone who wants to borrow. Now, these needs to go because we're recovering. We're over the pandemic. We've got enough, enough buffer for the consumer. Australian consumers saved 10% of GDP in the 2021 financial year, and this compared to normally 3 to 4%. And this is on top of they spent everything they could also buying online goods. So we saved a lot of money. There's a lot of buffer. So the interest rate need to return to a more normalized level for the economy to function. So it is going higher. But it is just returned to normal. So all of that together, we think the share market is still pretty good. It will deliver a good return, probably more single-digit return, with good dividend being the big component of it. Banks will pay more, resource company will still pay, and then every other corporates, if they can't buy anything else, they will pay out buyback or dividend. So there's a lot of income coming through in the next 12 months. So that will underpin the share market, aside from the M&A that's going to really spike up every second day we're reading about it, but that is going to be a feature as well. So sort of mid to slightly higher single digit return of the share market, not as fancy as last year, but still very good return compared to where the cash rate is. So we're sort of in that sanguine positive camp at this point.
Good. I feel better already, Jun Bei.
Welcome to my world.
Rob, how are you thinking about inflation, interest rates, and is it going to change the way you manage your portfolio?
Yeah, look, well, firstly, not really. I mean, my fund is absolutely bottom-up focused type of fund. That's high-quality businesses to invest in. So it doesn't really, we don't really alter the composition of the portfolio based on we think a certain macroeconomic event is going to play out or scenario. But having said that, I mean, you've got to be focusing on inflation and interest rates for sure right now. I mean, it's. I think in terms of inflation, I think a reasonable degree of what we're seeing right now will improve over the next 12 to 24 months, just on the basis that as we come out, as the world comes out of COVID, I think a lot of these supply chain issues and labour constraints can gradually improve. But I think it'll take a while. I think we probably, again, COVID's probably worse in a lot of other countries apart from Australia. So I think it will take a while, but I think that will resolve itself a bit. I think in terms of interest rates, and this isn't really, I mean, interest rates, regardless of whether you see inflation being permanent or transitory, interest rates are incredibly low relative to the strength of the Australian economy and the global economy. Ridiculously low, really. I mean, a bit like in 2009, where we just saw central banks, they respond to a crisis with very stimulatory monetary policy. And we see exactly the same thing with COVID. So I think, my personal view is I think the central banks really should be looking to raise rates, if not late this year, then in 2022, just on the basis that the global economy is very strong. And I think it distorts too many investment markets to have interest rates as low as they are. But I don't think that should stop investors investing in quality businesses and buying and holding them over that, say, 3 to 5 year period. I don't think that's a showstopper. But I could absolutely see it creating some small corrections or sell-offs from time to time over the next 24 months on that, because that's probably the main issue that most people are focused on, that inflation, bond rates rising. Obviously, I think everyone's aware that there are certain parts of the ASX that are probably susceptible to that, the interest rate sensitive stocks, and certainly some technology stocks which might have earnings that are quite a fair way out into the future. I think they're probably susceptible to a normalisation of interest rates. So, I think from my point of view, you just got to make sure you really come from companies you own, make sure that the valuations are reasonable. And I guess the other thing, just with inflation, the one thing we've been quite thorough is going through the portfolio and making sure the companies we own, in terms of are they seeing cost pressures, and if they are, do they have the ability to increase prices, or does this inflationary period have the potential to create some negative earnings impacts? So that's definitely something that we've had a good look at. I think Domino's had a recent example of that recently. So I think there's some little indicators that you've got to keep an eye on. But as a general comment, it wouldn't derail my generally positive view on this.
No, good. As long as they don't put the price of my margarita up. Cath, a sort of related question, Cath, for you. The low interest rate environment we've had for many years now, and better access has brought a whole new generation of retail investors to the markets, and many of them have probably only seen good markets, good times. So I'm interested in what SelfWealth is doing to position or educate new investors on market cycles and prepare for an eventual change, because it's not always going to be good. So on the education and positioning front, or messaging, what's SelfWealth doing there?
Yeah, absolutely. And it's something that we take very seriously. We consider it a responsibility of ours to think about, helping people understand long-term investment strategies, which can mean, of course, there can be dips in the market. And so, we've been fully committed for quite some time to providing independent education and content on the platform on topics like you've just mentioned, in terms of this can happen, does happen, please be aware of it. However, the mindset being, it is about being in there for the long term, and also about making responsible decisions in terms of, when you are making an investment decision. And look, from a SelfWealth perspective, we anticipate this next year, there'll be some increase in interest rates. However, from a retail investor point of view, you've got to bear in mind a lot of the retail investors are on our platform because they're of a generation where they're seeing the housing market continuing to increase. Number of those people are priced out of that housing market. So they're looking for alternate ways to grow their wealth. So, we strongly believe investment in equities will continue to increase and grow in the next year. We, of course, believe that investment in crypto as an asset type will definitely increase in the next year. And, we mentioned the education, and of course, we're very upfront in terms of speculative nature of crypto investments. But it is about presenting, that rounded view of, look, this is the risk, this is the type of asset, and, please be thoughtful of this as you're investing your money into these asset types.
Yeah. If we get time, or we probably won't get time, we won't talk about crypto, but if we get time, we might. Niv, the market, interest rates. I was maybe going to ask you about IPOs. Actually, it's been a hot market. It's been, I think we're heading for a record number this year in terms of IPOs, and I think there's another 30 odd to come between now and Christmas, which is extraordinary. I know the last quarter is always the hot one, but what have you seen? And I actually haven't worked out the market weighted performance of IPOs, but I think they've done reasonably well this year versus other years. So what are you seeing, ahead in the market IPOs and just the environment for new listings?
Yeah, look, there's a lot of money still sitting on the sidelines, and it's been a good 2 years. And I do agree with Jun Bei and Rob and Cath. It is going to get a lot harder. I mean, interest rates are going to rise. Cash is still king, we feel, and it's going to find it's all about being stock specific, sector specific. As you mentioned, Paul, it's IPOs. We're expecting 25 to 30 new IPOs to hit the market between now and Christmas. A huge plethora of IPOs coming through the range, which is exciting. I think investors really need to go and have a look at the capital structures. I think that's important. I think it's important to know how much money's been raised in the seed capital raise relative to IPO. Does management have skin in the game, or have they literally just plucked some of these assets, done some pegging on the ground for $10,000, $20,000, $30,000 and wanting to value for $500,000 or $1 million? So I think, look, some of the valuations are the key. Smart money will follow smart money. So once again, for those investors that are listening at home, it comes down to backing successful track record of management, and what have they done in the past and what are they doing in the future. So I think, look, we're seeing a lot of resource IPOs, Paul. We're seeing a lot of in the whole circular economy space, as I mentioned. Green hydrogen's a big theme. Uranium's a big theme. ESG investment's a big theme. So look, I think that's going to continue. But it is, I do agree with Jun Bei and Rob, what they are seeing, and yourself. It is going to be a much, much trickier year for 2022. But the only tip that I can give investors listening is just being stock specific, sector specific, and follow the smart money. That's the key.
Yeah, well, that's good advice. We'll stay on that theme though. So, the prevailing trends are going to be hard to work out, but you can look at sectors and stocks that look attractive given what we have ahead of us. So, getting to the pointy end of what our listeners are probably after, Jun Bei, can you point to some sectors or stocks that you really think are attractive through to next year?
Yeah, sure. Look, I am similar to what Niv said, and also Glenn said as well. I do believe so this year, because things are going to get trickier. It's actually not about just buying a sector. It's about buying the company within the sector. And obviously, because we're a long short fund, we can play long and against short. But we just find if you can actually find the company, doesn't matter what sector it is, and it actually best when nobody else likes it, that sector, you will generate the best amount of return. Now, I think before, let me point to a few names. Some of them may be very expensive companies. Some of them are cheaper companies. And I think if you get the right company, it doesn't matter what it is, it will do well. Overall market may be flat, but they will do well. So first of all, first one we really like is Seek. Now, Seek has performed quite well, but has lagged some of the growth companies. It previously, it always looked expensive, but now this is a company, after the restructure, this is a company that offers majority of the earnings as a domestic job board, and it has been, so strong in that positioning. It has a revenue significantly, over the last 15 years, it's been around, even though it's a mature market. And we think just for that domestic business, they will be very leveraged to the upswing of what's happening in the job market here in Australia. Companies can't find enough people, and the churn is still not as high because people are not leaving their jobs, and then there's just heaps of roles that just can't be filled. So Seek is well leveraged to that. You will be able to get double-digit growth in terms of revenue for just the domestic business. And then we think a lot of the investment into early stage Asian, Southeast Asian business will do well, will just start to generate return. And also buying Seek today, it gives you that exposure into the new venture, the early stage growth company venture that you can have exposure to. I must say Seek's management that runs that business, are probably one of the best that is in and best track record in finding the early stage business to partner with. So certainly that is a company. It looks expensive when you back out a lot of those losses and things. It's not any more than some of its peers, and it does offer you very solid growth, and it makes money. A lot of time when you look at those growth companies, they don't make money, and that's the area where you do need to be careful of, because valuation is too high for business, doesn't make positive cash flow. Seek generates good return and exposure into all these high growth areas, and we do think that's a really interesting space. Now, another one I heard Glenn mention earlier on. Okay, it was an expensive business. It became a whole lot cheaper recently. And, this is a little bit counter consensus. That's Domino's. Look, we know. So sometimes when investors invest, they tend to go top down. They're going, oh, stay at home winners, let's not buy them, sell them all, don't worry about it. Let's worry about it in a couple of years' time, and buy the, reopening thematic. Whilst it works, but we do find this is the time where you actually pick up those stay at home winners, sort of cheaply, simply because, at this point, no one wants to price in 2 years' time what the earning might look like. We think this business has been sold off very unfairly recently, and we think it has a lot in its business that will offer structural growth, not just cyclical growth like many other sectors. Once the reopening economy completes in 12-month time, many of those mature businesses will struggle for growth, and companies like Seek, like Domino, will give you much needed growth for your portfolio. You need a portfolio that's been future-proofed, whether you're in green energy or others, or structural leaders. You just got to have those businesses in your portfolio to benefit to the upside. Now I can go to a whole long list. Do I have time, or should I start? I'll leave others for
we might come back, but Rob, you might, besides Domino's, have you got a couple of names that look interesting for next year?
Yeah, sure. Look, there's two stock. Firstly, one that springs to mind would be MA Financial, previously known as Moelis Australia. So that's a business that listed in 2017. A bit like Macquarie Group, started off corporate advisory. They've got a very strong expertise in corporate restructuring and helping businesses emerge from financial difficulty. And they gradually transitioned that into asset management, and that's really now the driver of the business. Asset management makes up about 70-75% of group profit, and that's not. They do have an equities business, but they're probably bigger in the asset management parts of property and credit and hospitality assets. So, creating investment products for in a lot of cases high net worth. They are moving into targeting retail investors as well, but they've really targeted some specific niches in asset management where they've typically had historic knowledge and expertise from their corporate advisory arm, and created some products that they can see demand in the market. So that's a business that has very good management, very aligned. Senior management have significant holdings in the business, and I think they've got a really good platform for continued AUM growth. And so they were sold off very dramatically in the COVID period of March last year, but they've really emerged very strongly to that. And I think that's given they'd only listed in 17, that I think having seen trade through this last 18 months has given investors a good feeling of confidence that they can navigate challenging trading conditions. And I think they've just got a really good platform. As we all know, when Australian funds management businesses get it right and have a good platform for growth and have good product to take to it, they're very scalable. And I think MA Financial definitely has the attributes of some of the success stories we've seen on the ASX. So that'd be one. The other one that springs to mind, Premier Investments, which is a retail investment company. Obviously, everyone will know Solomon Lew, who's the chairman of that business, is a very significant shareholder, and that owns a number of retail brands, and has an investment in Breville, which has been incredibly successful. Mark McGuinness, who was the previous CEO, he left a few months ago and has been replaced by Richard Murray from JB Hi-Fi. So a very strong management team. They've got a number of very good brands. Probably the two that I'd call out that have particular scope for earnings growth coming out of COVID would be Peter Alexander, the premium sleepwear brand, and Smiggle, which is sells stationery and that kind of product to school kids. So Smiggle, his earnings have been impacted by lockdowns around the world. It's a genuine global brand, and I think that can perform really strongly coming out of COVID. And the other thing to call out with Premier is that they've got their own 100% owned company-owned distribution centre in Melbourne, and they're particularly well placed as the retail shoppers move increasingly online. So that's something that they benefited from during COVID. More people buying product online, which tends to be less discounted and higher margin for the retailer. And I think over the next 3 to 5 years, there's a lot more upside in terms of doing more business online, which has great impact for margins for them. So that'd be two that spring to mind. But I think there's definitely a number of stocks out there that are interesting right now.
Yeah, no, thanks, Rob. I hope they're paying rent again now. Niv, a couple of names. No pressure.
Yeah, I mean, one stock that we backed only a few weeks ago, we undertook a placement at 2.5 cents with a 1-for-2 options. A company called Latrobe Magnesium, stock code is LMG. And what's happening there, for those at home, there's a huge shortage in magnesium with what's happening with the whole lithium-ion battery space and automakers. Done exceptionally well. China just come out and saying they're disrupting the whole supply chain. Companies these days are looking for other sources of magnesium outside of China, and they're building a facility in Latrobe Valley in Victoria. So LMG, check that out. But we believe that's going to continue. And that, look, magnesium actually in the whole CO2 space is really interesting in terms of from a carbon emission space. Another company that we've backed recently, and I've been a major shareholder of, and I'm increasing, is a company called Timeless, which is TYM. I mean, carbon credits is something really interesting. What they've developed is they've developed a platform for the tracing and trading and monitoring of green energy units, such as carbon, but also across the board for energy transmission, virtual power plants. We think that's going to be a really big theme for 2022. Iris Energy just recently raised 200 million at 2 billion. I actually met Mr. Roberts, I think it was Danny Roberts here in the Wholesale Investor event about 18 months ago in Sydney, and he was trying to raise money. Then he goes out and raises 200 million and 2 billion and listing on the NASDAQ. They've just picked up one of the ex-directors or ex-CEOs of Iris Energy to join the board. So look, Timeless at around that 25, 30 million market cap is really interesting. So they're really the two.
Yeah, no, thanks. And Cath, I was thinking that SelfWealth is now offering, US trading to its investors, which is great, given we're only a very small market here. And this obviously helps with diversification. But do you know, how's the take-up been for individual US stocks rather than just sort of playing it safe and just doing an ETF? Do you know how they're going with individual stocks?
Yeah, absolutely. And so look, we've had conversion rates, 30% of our active traders now have US equities accounts. And as you rightly point out, when we look at the ETF split, if you like, between US equities versus Australian equities, on our US equities platform, very much focused on individual stocks rather than ETFs. So, which to me, there is certainly with certain demographics, particularly the millennials, there is a notion of, buy the stocks that you know. So it is very much a brand awareness piece in terms of, what people choose to buy from a US perspective. But I think, just to kind of add as well to what Niv was saying, we really are seeing a big trend toward, anything with lithium in it, anything related to EV. I think that investors in Australia are getting much more clued on in terms of looking for, what future demand is going to be out there. And, I think they too are also looking very seriously at, overhyped valuations of companies as well. And I think starting to look more at the fundamentals of, when is this revenue growth going to kick in? And hence, the buy now, pay later space has certainly changed its buy-sell dimension as well on our platform.
Yeah, no, thank you. Now, Jun Bei, I think you were going to mention Alibaba a minute ago, but what I would like to ask you was, what's the current view on China? There's no shortage of risk. There's sort of explicit trade sanctions. There's also implicit ones against Australia. You've got the decarbonisation theme, which is leading to some production controls, which are hurting some of our commodities. Property sector, debt load, shared prosperity policy, which is impacting regulation differently across various industries. So is it an avoid or an opportunity for the brave?
It's always an opportunity for the brave. Look, it's, when you look at some of those changes, from outside and you look at what's happening in China, and if you haven't followed Chinese market for a long time, it seems terrifying, and it seems, what is happening in that country, it's completely uninvestable. But to take a step back, look at what the government trying to do, and a lot of those policies has been trained for best part of last decade, if not more, has been sort of discussed. There's a lot of discussion paper towards some of those re-regulation of some of those sectors. Now, government's purpose is, in government's view in China, is that the corporates work for the people, and ultimately, if you generate a lot of economic benefit, you need to give it back to the people. Now, in a way, in its core, it's almost like what ESG movement is almost a little bit similar in terms of social, that you give it back to the community where you generate the profit. Now, from China, it's different because it's centralized. So, you work for the people, as in you work for the government. So, there's very explicit rules on, what you should do to generate the overall benefit. And so if you just look at the policy, it's essentially about, doing things more on more social front. So, making the living cost cheaper. So make sure the house prices doesn't rise as crazy as it has been. Making sure that, kids doesn't play, this is a little bit of overstep, kids doesn't play too much computer games, and limit the gaming hours. My kids won't survive. Limit gaming hours, and also at the same time making sure there's fair pay for small individuals, the minimum wage or minimum salary, and reduce the monopolistic power of some of those really large conglomerates, large businesses, which have done very, very well over the years, but it's just need to introduce more competition and sort of, equalize some of the power that they have gathered. So, this is what the government trying to do. And it's just happened that, all sort of took place in the last few months and seems consecutive of what's happening. Now, there is a discussion that because next year is the 25th year of the People's Congress, it's a very monumental and important year. Now, there is, speculation, or there is possibility that there will be more stimulus. So a lot of bad news are coming through this year. It's because we are getting ready and pave the way for that monumental year that is to come. Very, very significant for Xi Jinping for latter part of next year. So we are definitely expecting, more harmony in the, going forward after this year. And we expect a lot more support for consumer and small businesses, because ultimately government wants to bring, more spending power to the consumer. Remember, they're still very manufacturing oriented economy. For it to get to, its full potential, you really have to get people to spend. So you need to give jobs. You need to, stimulate the domestic economy to be self-sufficient. And this is where it's going. So in my view is that it is on its way to become to the next level, to become a more developed and more structured economy. And right now we're sort of going through the midst of it. And perhaps there's a little more to go, but, my view is that if you're a long-term investor for Chinese market, you have to be a long-term investor. You're not in it for a year or two, because these things take a long time to come through. And this is definitely it's for the brave, but we just see so much opportunity for a global investor.
No, thank you. That's a very good insight. Now we're nearing into time, so I just might finish with a personal question, if you don't mind. Feel free not to answer it, but investment management. Or even running a big platform, it's a huge responsibility. Managing other people's money is a huge pressure, and in these markets it's even more demanding because you just really don't know. It's tough being an active manager. So the question is more, how do you cope with that responsibility and pressure? But more, what do you do to turn off? How do you relax and take your mind off these crazy markets and this big responsibility? Happy for anyone to go first. Rob, I'm going to choose you.
Okay, sure. Yeah. Look, I think it's a big responsibility managing other people's money. I think the first thing we always make sure we do is know the companies we're invested in very well, and from a people point of view, make sure that the senior management and board that of the companies we're invested in are high quality people. And that's often from seeing their behaviour and the way they treat shareholders over a long period of time. So it's obviously a lot easier to judge companies like Mineral Resources or Alliance Aviation or Premier or ARB, because we've seen the management teams and the boards behave and respond to different scenarios over a long period of time. So, I mean, the first thing is if you hold really good quality business run by good people, that tends to reduce your anxiety levels, I guess, about the stocks you're invested in. I guess from a personal point of view, it's always good to get out and get a bit of exercise and ride and swim and play with golf from time to time and play with the kids. So, all those things, like a lot of people, can help you switch off. But, I think at the end of the day, if you invest in businesses, that tends to, reduce that stress factor.
Yeah, no, good point. Niv, how do you relax?
Every Friday morning, Paul, about 6 of us through COVID went down to Port Melbourne Life Saving Club, and we do a workout, go for a dip, even in the ocean here in Melbourne, which is absolutely freezing if you don't have the nice sun as in Queensland and Bondi. But yeah, look, I think switching off, I think it's hard because it is a 24-hour sport. Because when we wake up, the US Canadian markets just close. You go into Asia, then it goes to Europe, and it just continues. And it's hard switching off, but I think it's really important. Just the whole work-life balance, exercise, hiking, surrounding your friends, going out. Now that obviously things are opening up, there's going to be a huge push, especially leading to Christmas, to spend some time with family and friends. So look, but it is all about, doing your best, and we've got to, maintaining a good reputation and ensuring that you only surround yourself with racehorses and those people that are aligned. So, no, it's great to be here, guys, and a fantastic panel. So thank you.
Thanks, Niv. And Cath, how do you switch off?
Yeah, sure. I mean, look, SelfWealth, when you combine Australian equities, US equities and cash, we have over $8 billion of asset value on the platform. Being a listed company certainly makes us provide the transparency as we should in terms of managing those funds. So, how I relax is I have 2 amazing kiddies under the age of 9, and I make sure that I spend some fun quality time with them. And I find that really centers the mind as well in terms of getting that balance right, which is essential for everyone.
Good. And Jun Bei, how do you take your time off?
Well, I think I'm similar to Cath. I've got 2 young kids, and I actually incorporate, because my job is I manage $1 billion, and it's 24/7, never stops, and share market never ends. So I incorporate my work into my life, and I work flexibly, and I find ways to incorporate the dinner time, the kids pick up, and all of that. Now, the past reporting season in August was just be incredible. New South Wales was in lockdown, and I was homeschooling 2 young kids while running the $1 billion fund with the reporting season, and we had an amazing time, and the performance was good, and my kids was perhaps reading my reports, and and I have an amazing time. So I think it's it just work out what works for you, and for me, to relaxation is really find that balance and make it work for me, and integrate them.
Excellent. Well, we're right on time. So thank you to our panelists for joining us and sharing your insights. It was really wonderful. And thank you all for listening out there. We'll put the bios and the details of each of our panelists on a slide after the webcast. So thanks, guys, and enjoy your day.
Thanks very much.
Thank you.
Thanks, guys. Thanks.
Bye, everyone.
Thank you.
Thanks.